Nvidia is planning to turn artificial intelligence chips into a securitized financial asset to fund a historic buildout that dwarfs the entire United States defense budget. Byron Deeter, a partner at Bessemer Venture Partners, sat down on CNBC last week to unpack this high-stakes strategy and the risks of a looming credit crash. By the end of this, you will understand why this financing move is being called a financial weapon and whether this massive capital injection can actually avoid a hard landing. But as leverage enters the system, the real question is who gets hit first when the music stops. I'll show you the clip of the CNBC interview uninterrupted, and after that I'll give you my own reaction breakdown to what was said.
Here with us now is Byron Deeter. He's a partner at Bessemer Venture Partners. Nice to have you here.
Always great to be back. Thank you.
I'd love to get your reaction to this idea of creating a new, really, asset class is the ambition here. It's only a memorandum of understanding. There's no contracts here that say they have to raise this money, but they do have that idea of that, at some point we could have securitized, basically GPU markets, I guess, that are traded because there's some standardization. Dream or potential reality?
I think this is a great maturation of the ecosystem. Let's first remind people of macro numbers. $1 trillion is going to be spent by the big five this year in data center capex buildout. That's more than the entire U.S. Department of Defense budget at about $960 billion. It's more than the peak U.S. defense budget, even in war times, inflation adjusted. It's the biggest buildout in private markets history. And so another $500 billion is a statement about the intention for the build. And it's smart for Nvidia for two reasons. One is it counters the criticism of the balance sheet insider deals, the round tripping. The OpenAI gives them the deal, they invest in OpenAI. And to move that off, so it's a clear standalone business case. The second is further ecosystem lock-in. They've done a great job with their software development and the ecosystem there, investing in the companies. Now to have a financing advantage and a structural advantage for using NVIDIA GPUs is a financial weapon that they can use to pull in more ecosystem build on their stack. And I think it's incredibly smart, and I think that these assets will be investable.
Yeah, Jensen Huang also sort of coming out against that criticism that says, well, what about residual value? How quickly do you have to depreciate a GPU, pointing to the prices per hour actually having gone up for even older chips. Are you a believer that that will sustain over time? Because that could be an important part of the equation here in terms of what this financings look like.
So they are an investable asset. The demand is going to sustain, but these things always end hard with a hard landing. We know how these build-outs play out. And so there's a timing question. And if I'm an investor looking at this, I'm looking at the Class A credit, I'm looking at long-duration take-or-pay contracts, and I want that Tier 1 partnership structure to go with it. Because at some point, the marginal providers are going to get hit hard. We're starting to see leverage come into the market where people are trying to put debt on these things to juice returns as the model returns are coming down. That's only going to compound the risk, and the marginal providers are going to get hit first as there's some inevitable pullback.
I mean, does it raise credit risk, like that future demand is going to be more sensitive now to credit conditions and credit volatility? That feels like a big risk, no?
At multiple layers it is. And so starting with the debt side, which obviously has some backstop protection. But if you think about the equity tiers, part of why NVIDIA wants to move this off their balance sheet is for more clarity. They've been, I think, appropriately taking the criticism that they will be tied then to the fate of those who they fund. If you can move it off, have third parties justify it, they're still committing to a quarter of the capital up to $125 billion, but that's a discrete amount and an investment. If you have the folks like KKR and BlackRock that are financing these and valuing them on a standalone basis, people can look at those independent of the GPU business for NVIDIA and their core ecosystem businesses.
Demand still seems to be parabolic. Do you agree? And do you see that being sustained for years to come?
Right now, it's absolutely insatiable. And I think that's what investors should take comfort in. The criticism of these insider deals, for instance, were misplaced because they weren't to prop anything up. We were having a chip shortage. It was really to align interests with their participants. The enterprise business right now cannot get enough tokens provision. They cannot get enough capacity. Anthropic, OpenAI, the hyperscalers themselves have openly said they would have grown even faster if they had more supply of chips, of compute, of capacity. And so that's not where the shock's going to come from. We have massive demand that I see many quarters out. Where it may come from is technological innovation, where you find some unlocks, where they can deliver those capabilities, where the model performance can go up. You see these technological breakthroughs that happen in history with each architectural advancement. That's what I think will actually cause an inevitable shock through the system, whether that's the next chip iteration architecturally or whether it's a software innovation. Eventually that will happen, where performance and cost performance is massively disrupted.
That could be a real.
The conversation kicked off with the host asking Deeter for his reaction to this highly ambitious proposal to create what is essentially a brand new financial asset class. The host pointed out that while this is currently only a memorandum of understanding with no legally binding contracts to raise the cash yet, the ultimate goal is to establish a standardized, securitized market where GPU capacity can be traded like commodities or bonds. The host put it bluntly, is this a grand dream, or is it a potential reality? Deeter did not hesitate, calling the initiative a great maturation of the entire technology ecosystem. To help the audience understand the massive scale of what we are witnessing, Deeter laid out some truly staggering macroeconomic numbers. He pointed out that the big five tech giants are projected to spend a combined $1 trillion on data center capital expenditures this year alone. Let that number sink in. Deeter noted that this single-year capital outlay is actually larger than the entire United States Department of Defense budget, which hovers around $960 billion. It even eclipses the peak U.S. defense budget during active wartime, even when you adjust those historical numbers for inflation. This staggering capital requirement is exactly why the tech industry is looking beyond traditional corporate balance sheets to fund its next phase of growth. When companies are spending at this velocity, they cannot rely solely on cash from operations or diluting their shareholders with massive equity raises. Deeter explained that this is where securitization comes in. By bundling these GPU assets into specialized financial structures, developers can borrow against them, pulling future utility forward to fund today's build-out. It is a classic financial engineering play, but applied to the fastest depreciating asset class on Earth. Let us think about that for a second. If you are a lender, you want to know what happens if the borrower walks away from the debt. In a traditional asset-backed security, like a mortgage-backed bond, you have a physical house as collateral. If the borrower defaults, you foreclose on the home, sell it, and get most of your money back because houses generally hold their value. But what is a state-of-the-art AI chip worth in 3 years? This is precisely where the CNBC host pushed Deeter, questioning how Wall Street can safely securitize an asset that is effectively on a ticking clock. The host pointed out that Nvidia is launching new chip architectures on a compressed annual cycle now. With the Blackwell chips rolling out and the next generation already on the drawing board, the host asked how lenders can manage the risk of rapid obsolescence. If a specialized cloud provider defaults on its debt in 24 months, those older H100 chips sitting in the server racks will have lost a massive chunk of their market value. Deeter acknowledged this reality, but reframed it as a structural challenge that Wall Street is actively trying to work around. In his view, the securitization model relies on the immediate, high-margin cash-generating capacity of the chips right now, rather than their residual salvage value in the future. Lenders are betting on the near-term, insatiable demand for compute. They assume that even if a borrower struggles, those chips can quickly be reassigned to another developer who is desperate for training capacity and willing to pay premium lease rates. Give the video a like and subscribe to the channel if you want more like it, and let's carry on. My take is that this assumption of permanent, infinite demand is incredibly dangerous. It assumes that there is an endless line of well-funded AI startups ready to lease these chips at premium rates. But we are already seeing venture capital funding become far more selective. If the startup ecosystem cools down, that secondary market for leased compute evaporates. Suddenly, those Wall Street lenders are left holding warehouse shelves full of rapidly aging silicon that nobody wants to rent at a price that covers the debt service. This brings us to the core structural trick of this entire model, which is off-balance sheet financing. The CNBC anchor zeroed in on how this strategy shields the giant tech companies from showing massive debt on their quarterly filings. By setting up joint ventures or backing specialized cloud providers, the mega-cap tech firms can essentially outsource the capital expenditure. They get access to the massive compute capacity they need without having to carry billions of dollars in high-interest loans directly on their own corporate books. Does that sound familiar? It should. It is the exact same playbook used during the telecommunications boom of the late 90s. Back then, telecom companies set up off-balance sheet vehicles to build out massive fiber optic networks. They assumed the demand for internet traffic would grow exponentially forever and easily service the debt. When that demand failed to materialize fast enough, the entire system collapsed under the weight of unserviceable loans, triggering a historic telecom crash. Deeter did not shy away from this historical parallel. When the host asked if we are heading toward a similar reckoning, Deeter warned that a hard landing is a distinct possibility for certain parts of the ecosystem. He pointed out that while the long-term potential of AI is undeniably real, the short-term build-out is moving far ahead of actual software revenue. We are building the infrastructure for a metropolis before we even know how many people are going to move in. I went back and looked at the actual revenue metrics to see if Deeter's warnings hold up under scrutiny, and the numbers are highly concerning. Right now, the annualized revenue run rate for the entire generative AI software sector is estimated to be around $15 billion. Compare that to the $100 billion plus that has been spent on hardware over the last 18 months. To make that capital expenditure profitable, AI applications need to generate hundreds of billions in enterprise revenue very quickly. Right now, we are not even close to that scale. The CNBC host then steered the conversation toward the ultimate systemic risk. If a hard landing does occur, where does the damage concentrate? The host wanted to know if this leverage poses a threat to Nvidia itself, or if the risk has been successfully distributed to the broader financial system. After all, Nvidia has been reporting record-breaking net profit margins, but a significant portion of their sales are being driven by venture-backed cloud startups funded by debt. Deeter's analysis of this risk profile was highly nuanced. He explained that Nvidia has been incredibly smart about how they manage their customer mix. They are not just selling to anyone who knocks on their door with a term sheet. Instead, Nvidia has prioritized the hyperscalers, companies like Microsoft, ticker symbol MSFT, and Meta, ticker symbol META, who have fortress balance sheets and tens of billions of dollars in free cash flow to absorb any short-term demand shocks. For the smaller, highly leveraged cloud providers, Nvidia has often demanded upfront payments or structured deals that limit their direct credit exposure. While Deeter is right that the hyperscalers have the balance sheets to survive a downturn, where I land on this is that his view underestimates the secondary effects on the market. If Microsoft or Alphabet, ticker symbol GOOGL, decides to slow down their capital expenditures because their AI search or cloud features are not yielding the expected returns, Nvidia's order book does not just slow down. It hits a wall. The valuation of Nvidia is priced for flawless, compounding growth. Even a minor pause in hyperscaler spending would trigger a massive re-rating of the stock, wiping out trillions of dollars in market value across the tech sector. The discussion then shifted to the role of venture capital firms in this changing landscape. The host asked Deeter how venture capitalists are adjusting their investment strategies now that the initial hype phase is ending and the reality of infrastructure costs is setting in. Are they still willing to fund companies that require tens of millions of dollars in compute spend just to train a basic model? Deeter's response highlighted a major shift in the VC community. He noted that the era of funding wrapper companies, startups that simply build a basic user interface on top of OpenAI's models, is officially over. Investors are now laser-focused on application-level value. They want to see proprietary data, unique workflows, and clear customer retention metrics. The focus has shifted from training bigger models to building sustainable business models that can actually afford to pay for the compute they consume. This shift is critical because it directly impacts the demand side of the GPU equation. If venture capitalists stop funding unprofitable AI startups, those startups stop buying compute from the specialized cloud providers. When those cloud providers lose their customers, they default on their securitized GPU loans. The chain reaction is clear, and it is a classic credit cycle in the making. The host pressed Deeter on the timeline for this adjustment, asking when we will see the turning point where supply and demand must finally balance out. Deeter suggested that the next 12 to 18 months will be the critical window. As the current generation of GPU installations comes online and begins operating at full capacity, the market will finally see whether the enterprise demand for AI agents and automated workflows is large enough to justify the next wave of capital expenditure. From my analysis of corporate adoption curves, this process is moving much slower than the hardware cycle. Implementing AI into a legacy corporate workflow is not as simple as plugging in an API. It requires data cleaning, compliance reviews, security audits, and employee retraining. These processes take years, not quarters. This mismatch between the lightning-fast speed of GPU production and the slow, deliberate pace of enterprise software adoption is the real danger zone. What we are watching is a massive bridge being built across a very wide canyon. Nvidia and Wall Street are trying to use financial engineering and securitization to keep the construction funded, hoping that the economic activity on the other side will materialize before the bridge runs out of support. If they succeed, it will be remembered as the most audacious infrastructure build-out in history. If they fail, the write-downs on these securitized GPU assets will echo through the credit markets for a decade. Thanks for watching. Let me know what you think in the comments, like the video, and subscribe to the channel if you haven't already. See you soon.